$91 billion. That's Google's CapEx line on the most recent annualized run. For context, that's more than Costco's entire annual revenue. It's almost double what Apple spent on CapEx last year, and it's roughly 14% of all hyperscaler CapEx projected for 2026 globally. 3 of our 4 AI-driven forensic lenses just flagged a problem with how that number lands in the cash flow statement. Today, I want to show you what they found, where they disagreed, and why one of the 4 lenses dissented on the bear case. Follow the cash, not the noise. Most investors look at Google's earnings beat, the headlines clean, revenue grew, margins held, the street hit its number. What most investors don't do is read the cash flow statement next to the income statement. When a company is reinvesting at a pace that approaches its operating cash generation, the GAAP earnings number starts to disconnect from the cash that's actually building up on the balance sheet. The further that disconnect goes, the more your reported earnings rest on accounting estimates and capitalization choices, and the less they rest on actual money in the door. This is what we call the divergence trap. Reported earnings look fine, cash convergence quietly degrades while market fails to notice. The multiple has already compressed. Google is showing the early shape of that platform, not the worst case, not even the median case, but a specific shape on a specific number that 3 of 4 forensic lenses flagged in the same direction. That number is $91 billion CapEx line, and what's buried inside is the topic of this video. Let me walk you through it in 3 parts: what management reported, what the cash statement actually shows, and the divergence between the two. Most recent fiscal year, Google posted strong revenue growth. Operating margin held at double digits. Net income beat consensus. The earnings call language was confident. Management framed CapEx as a quote, AI infrastructure investment, end quote. The Wall Street response was a series of price target raises. Wells Fargo went from 361 to 427 on the back of the Q1 print. Other shops moved in the same direction. The surface read is AI investment story still intact. Growth is funding itself. The multiples deserve to be expanded. That's the consensus. Here's what the cash flow statement actually shows. Operating cash flow grew, but CapEx grew faster. The gap between the two, the free cash flow, has been compressing on a year-over-year basis. CapEx as a percent of operating cash flow is now sitting at a level that, if it persists, fundamentally changes the cash return profile of this business. Now, here's the thing. A company can run high CapEx to operating cash flow for 1 quarter, 2 quarters, even a full year, if the investment is going to compound on the back of the new revenue. That's the bull case. AI infrastructure now, AI-driven revenue later. The multiple is paying for the future cash flows that the investment will eventually generate. The forensic question is there evidence in the filings that the investment is actually compounding, or is it sitting in CapEx without any clear revenue line attached to it? When you run the divergence razor on Google, that's our cash conversion measure, operating cash flow divided by net income, healthy is above 0.8. Google scores well, so the basic divergence doesn't fail at the headline level. But the razor is designed to catch companies where reported earnings are inflated relative to actual cash generation. Google's earnings are real. The question this dossier raises is different. It's whether the CapEx is required to keep generating those earnings is sustainable. and whether the segments where that CapEx is being deployed are actually showing the revenue acceleration that would justify the investment. The dossier finds 3 specific signals where the answer is unclear. I'll walk through each one in the framework section. The methodology behind this read is what we call the forensic jury. It runs 4 AI-driven lenses across 4 different evidence layers, and it preserves the disagreement between them rather than averaging them into a single recommendation. We have the auditor reading the books. The architect reads management's language. The storyteller reads what management omits, and the sentinel reads the cycle. So the auditor reads the books, the 10Q, the 10K, the segment disclosures, the cash flow statements. It runs the divergence razor and looks for the gap between net income and operating cash flow. On Google, the auditor flagged the CapEx to OCF compression as a sell at a high signal, with the caveat that the absolute cash conversion number is still healthy. The flag is the trajectory, not the level. The architect reads management's language, so earnings call transcripts the 10Q narrative, the investor day decks. The job is to detect when the way management frames a number stops matching the number itself. On Google, the architect read management's framing of CapEx as generational AI infrastructure against the underlying segment revenue trajectory and flagged the gap between the framing's bullishness and what the numbers underneath show. The storyteller reads what management leaves out. This is the segment disclosure forensics. What gets disclosed at the granular level and what gets bundled. What used to be broken out and is now combined into a larger reporting unit. On Google, the storyteller flagged that the current segment disclosure structure makes the AI infrastructure spend hard to verify against the segment revenue lines that would justify it. Not because Google is hiding anything specific, the disclosure structure simply no longer lets an outside reader connect the spending to the return on a like-for-like basis. Then the Sentinel reads the cycle, the macro context, the competitive landscape, the historical analog. On Google, the Sentinel pointed at 2 pieces of external evidence. Hamilton Point Investment Advisors, an independent stock picker shop, published Market Insights piece on February 28th, flagging that the 5 major hyperscalers are projected to spend $645 billion on CapEx in 2026, a 135% year-over-year increase. Eric Vermulm, a CFA who runs a value discipline shop, published an allied Substack note on April 30th, pointing out that the data center build is nearing 1% of US GDP, and that historically, mega projects on this scale have yielded poor returns for the average investor. So 3 of the 4 lenses landed in the same place, sell at high confidence. The cash flow versus CapEx gap is real. The segment disclosure no longer cleanly tracks the spend to return path, and the macro context shows a build out at scale that historically suggests is hard to earn back at the average investor's level. The 4th, dissented. This is the part of the methodology I want to be honest about because it's where the most research tools fail. The dissent came in on the post-Q1 analyst repricing wave. After Google's Q1 print, Wells Fargo and other major shops raised their price targets. Wells Fargo specifically went from 361 to 427. The repricing is real. It reflects analyst confidence that the CapEx is funding revenue lines that haven't fully shown up yet. It reflects a view that the AI infrastructure story is still in the early innings. The dissenting lens, the one that landed hold instead of sell, read that the repricing wave as a real signal worth weighing against the cash flow gap. The lens didn't reject the bear case. It said the bear case is one of 2 reads, and the analyst repricing is the other. On the record, not averaged, not reconciled. That's the methodology promise. show the disagreement, and let the reader decide. So what's buried in Google's $91 billion CapEx line? The three forensic lenses say cash flow versus reinvestment gap that's compressing free cash flow on a trajectory that, if it persists, fundamentally changes the multiple this business deserves. A segment disclosure structure that makes it harder to verify that the spend is producing the return, and a macro context where the aggregate hyperscaler build-out is at scale that history suggests is hard to earn back at the average investor level. One lens says the repricing wave is real. It's a counter signal. The price target raises after Q1 reflect the view that investment is funding revenue that hasn't shown up yet. The bull case is on the table. So what this dossier does not say is which read is correct. What it says is, here are the lenses, here is the evidence each one reads, here is where they agree, and here is where they split. The dissent column is on the record, 3 of 4 on one side, 1 on the other. If you own Google, the question this analysis raises for you is whether the CapEx to OCF trajectory and the segment disclosure shift change your conviction at the current price. If you don't own Google, the question is whether the entry price is being set by the analyst repricing wave or by the cash flow underneath it. This is a forensic analysis, not a buy or sell recommendation. It's for educational content only. So you can actually download the full dossier and get every lens in the for specific filing reference for the chart. You can go to Independent Insightful Agents. The link at the end of this video will give you a place where you can run one free valuation for any symbol that you choose.